Citadel is a legal collection of zombie stocks that they are using to meet collateral requirements and temporarily avoid margin calls has just been exposed. Today I want to talk about what these stocks are and what they do, and why Citadel is only temporarily avoiding bankruptcy. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Nazim tweeted saying, guys, I just found their swap basket. And guess who the prime broker dealer actually is? Wait for it. Citadel Securities. They're using over 8,490 over-the-counter zombie stocks and swaps to maintain collateral and avoid being wiped out by a margin call. If we go to the broker-dealer directory and find Citadel Securities, we can see their current security list. These are the securities that they are using for collateral to meet margin requirements. This current security list is full of 8,490 different securities, and the majority of them trade on the pink sheets or in the over-the-counter market. Citadel holds ADRs, common stock and ordinary shares in thousands and thousands of these pink sheet companies, or these tiny companies or zombie stocks that trade on the over-the-counter market. Now you may remember a number of months ago I spoke about zombie stocks in more detail. These are companies that have previously been seller boxed by hedge funds, maybe Citadel Securities or maybe by many others, and have effectively been relegated from the New York Stock Exchange or from the Nasdaq. Many of these companies were seller boxed and forced into bankruptcy. They ended up restructuring, being listed on the over-the-counter market, and still trade to this very day, even though these companies are technically bankrupt. Some example of these OTC stocks is Sears, Blockbuster, Toys R Us, and many others. Once upon a time, these stocks were traded on the New York Stock Exchange, but they were relegated from the NYSE after their stock price fell below $1 per share and held there for over 270 days. Citadel and many other hedge funds obviously created billions of synthetic shares in these companies and seller boxed them or shorted them effectively into bankruptcy and off of the stock exchange. While Citadel was shorting these companies and creating billions of synthetic shares, they were also holding the underlying stock as well, and I imagine over the years have steadily been building their position in these zombie companies. Citadel likely holds billions and billions of shares in all of these individual pink sheet companies that trade on the over-the-counter market and therefore can't be accessed by retail investors. When Citadel needs additional liquidity to meet their margin calls or to meet their margin requirements, they pump some of these zombie stocks, therefore increasing the share price, therefore increasing their overall holding value. One perfect example of this is GameStop's old shorted or delisted baby company that sold Apple products called Simply Incorporated. 4 days ago, on the 7th of July 2021, this stock ran over 25,000% in a single day, from 1 cent per share all the way up to $3.75. Here we can see the chart, and somewhere around 10 o'clock in the morning, this stock was only worth 1 cent per share. Obviously, as the day progressed towards the lunchtime, this stock increased by 25,000% to $3.75 in a singular day. Now, obviously, this stock is traded on the OTC market and therefore can't be accessed by retail investors, and the trading in this stock is very, very thin, aka there's minimal liquidity. Therefore, it was very easy for market makers or hedge funds like Citadel to pump the value of this stock up, therefore giving it a market cap of over $63 million in the space of a few hours. Now, the reason why Citadel are using this to only temporarily avoid bankruptcy is because there's only a certain amount that they can pump these zombie stocks before they can't pump them any longer. If the pumping of these zombie stocks becomes too obvious, other hedge funds are going to turn around and start shorting these companies back down to where they came from, therefore wiping out any of the pumped margin gains. If we have a look at this Simply Incorporated stock now, a few days later, while the stock did run up to $3.75 or $3.55 on Google, it's now since already been pushed back down to only 15 cents per share. The market cap fell to now only $3 million, and therefore any gains that Citadel made in terms of their margin requirements have effectively been already wiped out in only a few days. As Citadel and other hedge funds pump more and more of these zombie stocks, other hedge funds become alerted to it and short these zombie stocks straight back down, effectively wiping out those margin gains. While Citadel do have thousands of securities that they can pump, this list is available for all to see, and I'm sure many hedge funds are already reviewing this list of companies that Citadel has the opportunity to pump, and is also waiting to pounce and short them straight back down. And guys, if you haven't already, be sure to sign up to Moomoo using the link in the description below to get 10 free stocks worth up to $2,500 each. That's a total of up to $25,000 and a guaranteed free share of Lucid on top of that. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not benefit from your order flow, and they do not sell your order flow to market makers like Citadel or to clearing houses like Apex Clearing. Moomoo actually clears your trades themselves through their own clearing broker, Futu Incorporated, which does also not sell your order flow. And speaking of being ready to pounce, you've probably already seen this tweet from Adam Aaron saying, "I keep getting asked when pounce. Know this, one is that I always keep my word. Two, I've said publicly a pounce would not happen before the second quarter 2022 earnings are actually announced. And number three, the press release issued today that quarter two earnings is to be announced on Thursday, August 4th. And therefore you can all read between those lines." Now, some have actually speculated what this pouncing from Adam Aaron is likely to be, and many people have decided this pounce could be a merger or potential takeover of AMC from one of the big streaming platforms like Netflix or Amazon. Now you may say, okay, the pounce is a merger, so what? How exactly does that help the apes, and how exactly does that help AMC? This post on Reddit says, well, allow me to explain. In the case of a merger, the companies in question will have their shares recalled, and new shares will be issued to the legitimate holders of the new issuing company or the taking over company, aka Netflix or Amazon. When the takeover happens, your AMC shares, if you are still holding them at that time, will be replaced with shares in Amazon or in Netflix. And it says now, unfortunately, for legitimate short positions, those do actually stay on the books and get transferred over to the new stock. aka anyone shorting AMC will have their shares also converted, and they'll now be shorting Amazon or Netflix. However, naked shorts are an entirely different story. Naked shorts and failed to delivers have to all be bought back or bought in before the new shares can be issued. Obviously, Netflix aren't going to issue shares to those holding synthetic AMC shares because it doesn't work like that, and therefore the synthetics need to be bought back before the new shares are issued. The legitimate holders of the old stock have to actually have those shares on hand and have real shares, not just IOUs and not just synthetic shares, to be turned in. Otherwise, things get messy real fast. And therefore, if on August the 4th, AMC do announce a profitable quarter and also announce a potential takeover by one of the streaming platforms, when the takeover does happen, those shares will be recalled, the synthetics will be bought back, causing the squeeze, and then a few days later the shares will be transferred into the new issuing company or the new taking over company if you're still holding your AMC shares at that point after the squeeze. Obviously, there's absolutely nothing that stops you from selling during the squeeze when the synthetics are bought back before the new shares are issued. But I also wanted to talk about what Adam Aaron can do and what Adam Aaron can't do. You may have seen this tweet from Astro saying he's losing faith in AMC and believes there needs to be some accountability of those who are supposed to maintain and better a company. If the can is kicked by him again in terms of actually doing something, he said he's moving on. Now, I think what Adam Aaron can do is improve and better AMC as a company. He can diversify business direction and diversify revenue into gold mining or selling popcorn in stores. He can go with the times and improve technology to accept cryptocurrency and issue NFTs. Adam Aaron can try a variety of different ideas, such as merging with different companies, issuing new shares, performing share buybacks, issuing dividends when the company is profitable, and more things like that that improve AMC as a company. But what Adam Aaron can't do is Adam Aaron can't control the SEC. He can't control the DTCC. He most certainly can't control the Department of Justice or the FBI or the Fed, and he can't control these billionaire short sellers that can basically basically get away with anything because of the connections that they have in the market. Adam Aaron can't control this cabal of billionaire short sellers that are in bed with the SEC and the DTCC. Adam Aaron can't say SEC, DTCC and Department of Justice, do your job because I'm controlling you. After all, Adam Aaron is only the CEO of a movie theatre chain over at AMC. Adam Aaron isn't the President of the United States and the Chair of the Federal Reserve and the head of the Department of Justice, therefore making any decision he so wishes. Adam Aaron likely doesn't have Ken Griffin and Gary Gensler on his payroll, paying Ken and Gary to do exactly what Adam wants. Therefore, Adam Aaron can try his absolute best to improve AMC as a company. But what Adam Aaron can't do is control Ken Griffin, control the SEC, the DTCC, and the Department of Justice, and much more. Now, something that is very interesting about the GameStop stock split is that the split will instantly multiply the number of fail to delivers by 4 and the number of fees charged for these fail to delivers. This tweet said if you had 1 million shorts or 1 million FTDs after the stock split via dividend, you now have 4 million shorts and 4 million FTDs. The NSCC cost after 30 days would have been $3 million. Now it's going to be $12 million. And that means that short hedge funds are going to be squeezed some more and closer to those margin calls. This screenshot shows a guide to the 2022 NSCC fee schedule. We can see that for continuous net settlement, a fail to deliver on that CNS is a 0.25 and a 3.00 fee. There's a 0.25 fee per item or per share short in CNS for 1 to 30 days at the close of business, and a 3.00 fee per item or per dollar short in the CNS for more than 30 days at the close of business. So I guess this is a $3 fee per share shorted in the CNS for more than 30 days. And again, this just pushes these shorts closer and closer to that margin call position and pushes these funds and market makers like Citadel closer to that margin call as they're running out of zombie stocks to continue pumping. Finally, David Rosenberg asked a rhetorical question saying, could this be the first recession bear market that managed to bottom before the recession actually even began? He said normally the bottom happens just ahead of the recovery. I think what he's basically saying is this small recovery in the S&P 500 that we've seen over the last week isn't in fact a recovery, and it's the crash just getting started as the recession has only really just begun. Again, I think over the next week or two the S&P 500 is likely to fall back below my line and to continue falling below this 350 area. As I said previously, I drew this line back in March and April showing the direction of the S&P 500. Sometimes the market falls below my line and sometimes the market sits above my line, but over the next say 3 to 6 months the S&P 500 is likely to continue trending downwards following this directional line. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.